Hi, my name is John Palmer, and I'm the lead portfolio manager on the real estate strategies at Westwood. Today, I wanted to share a little background on the Westwood Salient Select Income Fund, an investment strategy that has a 22-year track record focused on investing in the niche REIT preferred securities market. Before I dive into why we think this is a timely area of investment for advisors seeking income for their clients, I think some context is needed. As many of you may know, the majority of the preferred securities universe in the United States is not issued by REITs. Rather, the majority is comprised of preferreds issued by banks and insurance companies, what we refer to as financial preferreds. The majority of these financial preferreds trade in the $1,000 par marketplace. They typically have fixed to float coupon structures that are non-cumulative. They are perpetual instruments with no stated maturity, and they are typically callable 5 years after issuance. It's a large and institutionally driven market with many sophisticated investors participating. On the other hand, the REIT preferred securities market only makes up approximately 10% of the total preferred securities traded in the United States. These REIT preferred securities are typically $25 par instruments with fixed for life coupons, and they are usually perpetual securities that are callable 5 years after issuance. Importantly, all of the REIT preferred securities have cumulative dividend treatment, which we'll come back to later. Given its smaller size, this marketplace is much more retail in nature, with few institutional participants, leading to wider spreads and greater opportunities for security mispricings. In our view, it's a marketplace ripe for active management. So with that background, I would like to share 4 key reasons why we find this investment niche compelling for investors today. First, REIT preferreds have historically offered investors elevated yields relative to financial preferred securities. As the chart indicates, this yield differential has averaged roughly 100 to 150 basis points relative to financial preferreds over the past 5 years. But really, that yield pickup has been fairly consistent over the past 25 years, despite the various interest rate regimes we've encountered. This attractive income component has historically accounted for roughly 2/3 of our fund's total return. Secondly, listed REITs utilize dramatically less leverage in their operating models compared to financial firms. Currently, when looking at debt to enterprise ratios, publicly traded REITs average approximately 29%. After factoring in preferred equity, which typically makes up less than 10% of a REIT's capital stack, REITs on average have 50 to 60% common equity sitting junior to the REIT preferred equity. That large loss absorbing buffer gives us confidence that the preferreds will retain their value over time. Compare that with the equity buffer of a bank. They typically have just 8 to 10% common tier 1 equity capital sitting below their preferreds. In our view, that's a very shallow buffer. So despite the regulatory reforms that followed the great financial crisis, banks remain levered 9 to 1. It is our opinion that when underwriting preferred securities, we favor less leverage versus more leverage, which is clearly the case with REIT preferred securities. Third, the REIT structure offers investors far more transparency than financial firms, giving investors greater ability to underwrite the underlying cash flows these companies generate. When you analyze the balance sheet of a REIT, you know where every building that they own is located. You often know who their largest tenants are. And through many available data sources, we are able to get nearly real-time feeds on where building occupancies are at, or asking and effective rent levels are penciling, even what maintenance CapEx is costing. And importantly, buildings trade hands in the private markets every day, providing additional price discovery. Things couldn't be more different when looking at the balance sheet of a bank. Bank investors typically get zoomed out loan statistics, often with stale LTVs and FICO scores. You also run across derivative books, opaque level 3 assets that are hard to value, as well as security portfolios that are not marked to market. which was really the cause of some of the recent bank failures. In our opinion, we favor transparency over opacity, and REITs provide a much higher level of transparency. Lastly, as I mentioned earlier, most financial preferreds are non-cumulative instruments, whereas all of the REIT preferred securities have cumulative dividend treatment. While we fortunately haven't had many credit events in the REIT preferred market in the past, a recent example provides the benefits of cumulative dividends. During the initial stages of the COVID crisis, the lodging industry across the US was facing significant stress given that most travel had ceased. REITs reacted by working with their lenders to get amendments to their credit agreements. They furloughed employees and even closed hotels to minimize cash burn. All lodging REITs substantially cut or completely eliminated their common dividends. However, Hersha Hospitality, a publicly traded lodging REIT, made the painful decision to suspend their preferred dividends as well. However, unlike the preferred dividends of financial firms, these dividends are cumulative, meaning they continue to accrue while they were suspended. Following the successful rollout of the COVID vaccine and the resumption of travel across the United States, 12 months later, Hersha was back in a position to restart their common dividends. But in order to do that, they had to first pay back the 4 quarters of suspended preferred dividends, which they did. Had this been a financial firm, those preferred dividends would have remained unpaid. It's a unique example of why we favor this structural enhancement. So in summary, given these 4 factors, higher income, lower leverage, more transparency, and cumulative dividends, we believe the case is compelling for investors to seek out REIT preferred securities as an income generating component for their clients' portfolios. And we look forward to answering any questions you may have about this strategy. Thank you.